Good afternoon, everyone from Singapore, the heart of the CBD, Bull or Bear 2023. You're on the show 5 with BlackRock today. We're covering healthcare and technology outlook going into 2023. Now, over the past few days, we've had a series of talks for you. We've, really put together this content just for you, tailor-made, so that you can have access to the experts that we work with and also lead with research and data as you proceed on to decide what to do and what to look out for in terms of investment opportunities in the new year. Now, as we round up 2022, we've had a couple of shows. We've also, the speaker that you're about to see today, we've had shows with them as well. And so today is a chance for us to check in to see where we are right now at the end of the year and how we can readjust and perhaps revisit certain parts of our portfolio and see where we can tweak it so that we can overall have a better investment strategy. Now, today we've got BlackRock with us on the themes affecting global healthcare and technology sectors. And once again, I'm your host, Olivia Higgins. I love seeing the familiar faces on the show. Thank you so much for saying hi as well on our offline events. And we really, really value your support and also you being here as part of the discussion. So today, let's find out what are the elements of global healthcare and technology that can remain relevant in your portfolio as we go into the new year. So with that, I would like to introduce our expert for today from BlackRock. We have product strategist, Ben Bay. Hi, Ben. Welcome back to the show.
Hi, Olivia. Good afternoon. Good afternoon, everyone from Futu, Singapore. Nice to be here, and thanks for having me.
Thank you for coming back on. Now, you were in our show mid-year previously, and now we're going into this Q4 investment strategies outlook. So where are we now, Ben, compared to when we had our last show?
Yeah, I think compared to a couple of months ago, at least for the market volatility, we believe that we're getting more closer to the end of the tunnel. We're not there yet, but yeah, compared to the mid-year, I would believe we're actually getting into a better position.
Mm-hmm. Yes, absolutely. And so with this topic, healthcare and technology, how would you set the stage before we go into your analysis on, just the context of right now and why should the audience be listening to this insight?
Yeah, sure. Healthcare actually, in my view, it is a very defensive sector. So in this kind of market volatility, we can see that the healthcare is outperforming the rest of the sectors and also the broader equity market. And from next year perspective, if people are concerned about like the recession concern, etc., all these actually macro context fit bode well for healthcare sector to outperform. So this is a defensive sector. Actually can has some value and resilience in this kind of market. Well, for tech, this is one sector under very big pressure year to date, I have to say, due to the macro, due to the rising interest rate, etc. So there are lots of negative news on tech in past like 12 to 18 months already. But on the other side, we can see the valuation is much cheaper compared to a year ago, and some good opportunities are emerging as well. So yeah, one is defensive, and one is actually with some opportunities after the de-rating. So yeah, different risk appetite investors can actually pick the right candidates for their investment.
Absolutely. And I look forward to your insights that you're about to share. Now, to the audience, we've got a couple of giveaways throughout the show to reward you for being with us. But at the same time, it's about engaging and listening to the insights so that you can learn as much as you can. Remember, the purpose of these shows is to craft content for you so that we can guide you towards making better investment decisions, leading with analysis and the right data. Now, with that, Ben, we look forward to your insights. The floor is yours.
Yeah, sure. Thanks, Olivia. That actually, I prepared some of the slides to illustrate our view for technology and healthcare. And we can actually start from technology. If you turn to our slide here. So basically, in terms of I will start with the fundamentals. Yes, this is the slide. So basically, in terms of the fundamentals, we do see actually quite many technology subsectors are facing some challenges in recent market environment. So of course, a lot of like the recent pressure year to date, it is due to the macro, due to the rating pressure, high growth, high multiple segment actually saw mounting pressure due to the interest rate and inflation. However, in the same time, I have to highlight that some of the fundamental challenges as well for technology. So actually, a lot of companies, we do see some of deterioration of the fundamental outlook, and especially, for example, the COVID beneficiaries. So if we're talking about the COVID beneficiaries, including like e-commerce, internet, live stream, and consumer electronics like hardware, PCs, tablets, smartphones, for all these kind of sub-industries, they benefited in the COVID situation. So when people working from home, they actually got benefited. But now actually, because the world is getting out of COVID, then actually their demand is coming down a bit. I'm not saying that their long-term outlook will be much worse than what we were expecting, but given that they had a very high base in the past 2 years, and now actually it is time that the demand will slow down a bit. And a lot of consuming power has been pre-consumed in past like 2 years. So that's the situation. And some other areas like enterprise software, etc., are relatively steady, but also saw some weakening trend in recent months. So overall, the fundamentals of the tech is coming down a bit, but it is not a totally surprise to the market. I think the market has expected it, and we do see continuous revision down of the earnings from the market participants as well. There are some areas actually saw relatively strong tech demand, including like the alternative energy, green tech in our view, and also like electronic vehicles and its supply chain. These areas are super strong in terms of their fundamental growth in recent months, and some other areas like the cybersecurity, the demand is also very strong. So overall, there are some areas or some weakening signals within tech, but the other areas actually are still relatively resilient. So in our view, it is diverged in terms of fundamental outlook. The market has been reacting to the recent trend already. So some of the potential revision down is in the price in our view. If we go to the next slide, that I know I'd also like to mention about the recent drawdown. So basically, the drawdown for the tech sector started in November last year, and up to now it has been almost 1 year. And we had by this chart we can see it is about 9 months, 10 months, but it is almost like 11 months and 1 year now. And from the peak to trough, we are showing 30 to 40% drawdown already. That is actually a pretty big drawdown in the history of the tech sector. So we took a look about the past 20 years history of the technology, which actually there are 4 major or 5, including this one, there should be 5 major drawdowns within tech. You know, if you use NASDAQ as a benchmark, then in the past 20 years. So tech sector beyond 20 years ago, that's like 1980s or 1990s is not that relevant because the constituent stocks are quite different from what we are now. So past 20 years may be more relevant, and there are 5 major pullbacks. The largest one was in 2008. Then actually it is not surprising. It was due to the great financial crisis. Then actually we have around like 16 months duration in terms of the drawdown, and the pullback was actually 55%. So that is actually a pretty big one. The second largest was 2002. That was a 45% drawdown, about 10 months. That was actually due to the tech bubble bust. So that is actually 2 largest historical drawdown for tech, and now we are in the third one. Actually, the duration has been catching up from the 2002 one, and we believe some of the drawdown in certain areas of within tech are comparable to 2002 as well. So I can say we are now the second largest drawdown in the history of tech in the past 20 years, just following the financial crisis. Well, compared to financial crisis, because the whole financial system was under tremendous pressure by that time, and the sustainability of the financial system was under question mark. But this time, actually, we don't see that is happening. So the recent pullback or derating is mainly contributed by the macro factor, like the rising inflation and the interest rate hikes. So from that perspective, we believe the situation is not as bad as 2008. So from that perspective, we believe the current one, we should not expect if the current pullback should be similar in terms of the duration or the magnitude compared to 2008. So maybe comparable to 2002 is more reasonable, but we are already there. So from that perspective, I have to say it is already a very big drawdown within tech. If we go to the next slide, we can see we do see very big divergence within the technology sector in terms of different group of the tech. So in tech, we actually can broadly divide them into like a growth tech and or emerging tech. And the other camp will be the value tech, that are mega cap technology companies. So in past 12 to 18 months, clearly the investors favored a lot to the mega cap and the value tech. So if you look at the free cash flow margin, actually it is one big deciding factor for tech performance. So a positive free cash flow, companies outperformed, while negative cash flow companies underperformed, regardless of the growth. And we also look at the like market cap. So basically, large market cap companies outperformed the last year and also as well as this year. And on the right-hand side here, you can see we actually divided the tech companies into the 3 buckets based on their growth. So the highest growth segment actually underperformed. The revenue growth over 20% underperformed year to date, while the lowest growth actually outperformed, which is pretty counterintuitive and a counter precedence in our view, because historically, when investors, they want to look at technology investment, they like growth because they believe the tech should be representing the growth. While in the past 1 to 2 years, investors are dumping growth. Basically, even they stay with tech, they actually hide into the value tech or the large caps rather than buying those high growth tech. So that is actually happened in the market. Anything high multiple has been punished significantly year to date. So it is the pattern. It is just an illustration how bearish or the conservative the sentiment has been in the market about tech investment. Looking to the next slide. So after after a very big pullback, then where are we in terms of the valuation? So here we used the EV to multiple, EV to enterprise value to revenue as a multiple to illustrate the valuation for technology sector. While in the peak level that we saw in early 2021. So if you remember, we had a very big rally in January 2021. Actually, that was a peak of the tech globally. That actually the EV to revenue multiple reached close to 7 times by the time. That was a historical peak of the tech valuation in the past like 20 years. And then now we are actually trading at about 3.5. So literally the overall tech segment valuation halved in past like 1 year. So 1 year to 1.5 years. So that actually is a very big derating in terms of the overall global technology sector after this kind of 1.5 years derating. It is a very big one. And now we are trading around like 2017 to 2018 level of valuation, while tech fundamentals has been much stronger than like 5 years ago or 6 years ago, while the valuation is now actually similar. So that actually means that from valuation perspective, it is a pretty attractive in terms of the multiples versus the fundamental outlook as of now compared to past 2 to 3 years. If we look into the next slide, that is actually we show the valuation charts for different subsectors. Then we go to the next slide. So basically, some of the subsectors we saw very large or even larger than the market derating, especially for like internet. So internet, we saw like over 60% valuation derating already from peak to trough as of now. So that is actually around 2/3 of the valuation is gone. And the internet, ironically, now it is actually trading at almost a historical trough level of valuation. So it is close to the low end of the range of valuation in past 20 years. So it is very cheap global internet. The second largest derated subsector is software. So software actually saw a very big re-rating in recent years due to the fundamental outlook, due to their changing their business model from selling the products to a subscription model, which actually enhances the fundamental visibility a lot to software companies. So re-rated. However, now actually they had over 57% derating, and now actually the valuation is now back to 2017 to 18. And for other subsectors like services, semiconductors, they actually saw around like 40-something% back to 2018 level of valuation. So all the subsectors, so very big derating already, while the internet saw the largest one and particularly cheap among all the subsectors. So that is actually what's happening in the tech segment. Back to you, Olivia.
Thank you so much, Ben, for that. Now, I've got a couple of questions just to extend beyond what you just shared, yeah? So the first one would be, you're talking about the layoffs in these multiple tech companies. We highlighted from the beginning, we set the context, there are still existing problems that we've seen throughout the year, and we don't know yet if they're going to go away. But let's zone into the layoffs in multiple tech companies to reduce their capacities as well. Does this mean that tech companies will also be reducing their investments in R&D or just research and product development?
Yeah, sure. That's a very good question. Actually, we can get back to the page 2 of my slide. So the layoff in the big tech companies recently, that actually is due to the fundamental outlook. If we go back, get this slide. So as I mentioned, a lot of tech segment saw some weakening trend of the fundamentals. Their earnings is coming down. Then actually, from that perspective, they need to cutting the cost to at least give the cutting the cost to actually boost up the earnings for their shareholders. That is actually not surprising to see, and especially as I just mentioned, all the COVID beneficiaries actually will see some larger pressure of the slowing down of the earnings because they had a very big spike up of the earnings in past 2 years due to COVID, and now they will actually have a high base and also the coming weakening consumer demand. Then actually, if you look at the recent layoff, we were talking about some high-profile layoffs. They happened from those COVID beneficiaries, that including e-commerce company, including an internet company, social platform. Those companies all benefited in COVID, but now actually saw some weakening trend, so they have to cut in the cost. But we don't think that they were cutting the investment into the R&D. That actually is super important for those tech companies for future growth. It is more like they're cutting some of the operational cost at this stage. And our view is actually, given the situation now for tech, it is the largest overhang is still the inflation very high, and the Fed continue to hike the interest rate. While the one of the key contribution or factor for inflation overall is the wage inflation in the U.S. and due to the labor shortage. And after this kind of trend, we see people started to see layoff, etc. The labor market may deteriorate a bit. Then actually wage inflation may come down. That actually may trigger a slower growth of the wage in the coming year, which actually should help to see that overall inflation will come down as well. That is actually pretty positive for tech companies in terms of their stock performance. If we will see the peaking inflation and the Fed rate hike to slow down or potentially stop.
Rising rates environment. Now, how will these tech companies fare next year? I know you covered a little bit on that, but maybe just to recap, maybe you could just summarize and give us an outlook based on this. Yeah,
our view that how tech will fare for next year, actually the key factor to watch will still be the inflation. There are actually a lot of other factors influencing the market, including the potential recession concern, and also like some geopolitics, and also about some tech company specific factors. But overall, we believe the largest factor deciding the performance now for tech overall will be the inflation, and a lot of other macro factors, including the interest rate, 10-year treasury, etc., actually will be dependent on the inflation print. So inflation is a key data we need to monitor. So our view as of now, we actually believe the inflation should potentially have peaked, but the question mark will be how fast it will come down. And we believe the central banks will actually set the inflation target at about like 2%. That is actually pretty low. And our view is pretty hard to achieve that kind of level of value inflation. But if ultimately the target could be practical target could be like 3% around that level, then actually it's still in our view could be achievable. We are not achieving that level from like 7-8% out of now within like 1 quarter. But if we can achieve that within the next 3 to 4 quarters, then actually there will be a pretty positive signal for tech investment already. And our view, ultimately, the market has pretty much priced in some rate hikes in advance. It's just a matter how big it will be. It will be bigger than the market expectation or smaller than expectation. So as of now, the market is now expecting another 50 bips hike in the December Fed meeting. That actually will be about, the market is now pricing about 2/3 of the chance to see a 50 bips hike, and the other ones at about a 75 bips hike. And for next year, the largest bet from the market now, it is about 1% interest rate hike for entire 2023. So if it is a 50 bips hike, then actually there will be only 2 hikes for next year. So we do see potential slowing down of the rate hikes for sure. But it's a matter how inflation will come down, how fast it will come down to achieve like 2 to 3% ultimate target will be a deciding factor. We are relatively positive at this stage, because if the inflation is coming down continuously, then actually from the Fed stance, they should actually switching their focus gradually from inflation curves to stabilize the economy and the job market. Then actually that will be a relatively benign situation for tech.
Right. So inflation. Let's go to the U.S. and related to this. How will the U.S. Inflation Reduction Act impact the healthcare sector? Going back to the topic of today, healthcare and technology, especially for those who just joined in, what do you think of that, the U.S. Inflation Reduction Act?
Yeah, the U.S. Inflation Reduction Act is a very big bill. I have to say it covers a lot of different segments. It is much more than just about the inflation reduction as itself. So actually we have one slide if you go to, that's about the Inflation Reduction Act impact to healthcare sector. So the bill actually had 3 pillars regarding the healthcare. If you go to the slide number 7. No, the previous one. Yep, go back. 3 slides back. Yeah, this one. So basically, there are 3 pillars about the healthcare from the Inflation Reduction Act. One is about the out-of-pocket money from patients. The second is about the premium growth for the insurance companies. And the third one will be the largest one, is about the direct negotiation of the drug pricing for the Medicare system. So for the first one, it is the Inflation Reduction Act actually set a cap for out-of-pocket expense for patients. Starting from 2024, it is about, I remember it was like 4,000 to 5,000, but starting from like a year later, 2025, it is about 2,000 inflation reduction, 2,000 out-of-pocket expense cap. So that means for the patient, what they really need to pay will be capped at 2,000 from 2025. That is actually a big benefit for the patients who actually need to take therapies or treatment or take drugs periodically or constantly. That will actually especially helpful for those chronic disease patients. Because now, if under the system or Medicare benefit, they actually need to co-pay some of the money. So if maybe they can need to co-pay like 10% or 20% of their healthcare expense. And that actually can be a very big number as well, despite it is only 10, 20%. But if they are chronic disease, they need to take constant treatment, it could be a big money. And now actually their out-of-pocket expense will be capped. That actually a big benefit in our view. And the insurance companies will potentially need to bear the increased responsibility for that. So naturally, then actually a lot of insurance companies, they may like to hike their premium. So that is why the second pillar of the bill, Inflation Reduction Act, was actually to curb their premium growth. So you can see from 2024 to 2030, the Part D premium, Medicare Part D premium will be growth will actually be no more than 6% per year. So you cannot like hike your insurance fee as you want. They will actually have a cap about 6%. But that in the normal years should be enough to cover the inflation of the healthcare expenditure, the healthcare inflation. But in the like high inflation year, like this year, it may not be enough. But overall, in the longer term, we actually still believe for insurance companies, like 6% per year increase limit should be sufficient unless it is a very extraordinary long-term high inflation period. But in the normal terms, that actually should not be a big impact to the insurance. The third pillar is about direct drug pricing negotiation between the government and the pharmaceutical companies. That is actually the largest one, our largest impact. So the bill stated that they will pick the top-selling drugs in the Medicare system, Part B and Part D, and then direct negotiation. And the negotiation, in our view, will definitely bring the drug price down significantly. So that actually triggers some of the investors' concern. But however, there are some caveats or actually offsetting effects for that. First of all, it only impacts the top-selling drugs in the Medicare system. It is a system designed for the relatively lower income class in the US. So the majority of the US population, or like mid-class or above, with commercial insurance, it is not impacted. So it's basically only on the Medicare system patients. And they will not cover all the drugs. The second point is they will not cover all the drugs. There will be a selected drugs in the Medicare system, Part B and Part D. So we list out here 2026, 10 drugs, 2027, 15 drugs, etc. Ultimately, there could be reaching about 100 or so. Drugs will be under negotiation, but that one is only applying to the Medicare system. The second is actually not impacting all the drugs. From the company perspective, our view, we have three views. One is for companies with a large revenue exposure to Medicare system, their earnings may be impacted negatively if they actually, a lot of their revenue are from this. But if their products are not selling to the Medicare or actually selling to the non-US patients, etc., their revenue will not be impacted. So it is more like a company-specific factor to consider. Are they having a lot of revenue coming from Medicare system? The second is we actually believe the volume of the drug will go up if the price is coming down, which is actually natural. So that actually, there could be some offsetting effect from the higher volume after the price cut as well. So the overall impact to revenue may not be as big as the magnitude of the price cut directly. Lastly, we actually believe the new drug may be set at a relatively higher level of pricing to consider they may actually enter into this kind of price negotiation soon. So in the past, when the new drug come into the market, the pharma or biotech companies, they will actually assume they can have the control for the pricing for example, like 20 years according to the patent. But now actually they know they could potentially be under negotiation in the 7 years and the 11 years time after the commencement of the drug. There actually the potential initial stage pricing will be higher to offset that. So actually we believe it is not that bad as people fear the outcome. So actually healthcare sector didn't perform badly after the Inflation Reduction Act was announced. The performance was quite resilient and pretty solid since the announcement, which actually reflect the market view these policies actually was not as bad as people feared. And now we are after the midterm elections in the US. That actually we have a relatively split Congress again, and that is actually a typical. That is actually a typical benign environment.
Yeah. Could you just share further on your thoughts on that? So at least from what you just shared about the healthcare and the different policies in place and overall, just reducing the inflation impact, how will the midterm elections sort of lead on to the next year?
Yeah, actually we believe that the midterm elections means the chance for a large healthcare policy to come out near term is quite limited. First of all, we just had the Inflation Reduction Bill. That is actually one big bill about the policy changes on healthcare, and it will take years to implement that. So you can see the bill is talking about 2024, 2025, or even beyond to 2030. So before the 2030, this bill is fully implemented. We believe the chance for another large policy come out is relatively low. And also after the midterm election, if the House and the Senate become split, the split government of in the US, there actually is a relatively benign environment for healthcare sector, because normally in the past we view the split government means less chance for a drastic policy to come out, because actually a lot of things need to be compromised to reach agreement. Then actually it is better for healthcare, because actually this sector, we don't like too much policy, because if the policy come out, normally it is not a good policy. Then actually, if there's no policy coming out, that is positive for the sector. So from that perspective, we see it should be a positive reading on the midterm election results.
Thank you for sharing that. A lot of the discussions the past few days with the shows centered around these topics. And of course, you provided that in-depth analysis regarding that. So thank you. So just to end off our chat, I've just got, an industry question. So, which areas of the healthcare sector will look attractive in the new year, 2023?
Yeah, actually, in our view, a lot of health sectors actually do look attractive, but there are some areas maybe worth taking a look. That if you go to page 13, that is actually could be the last slide. That is actually some innovative areas, because we always say healthcare is a defensive growth sector. Despite it is defensive, the defensive comes from the fundamental of the healthcare is not impacted by the macro cycles, the inflation, interest rates, or the GDP growth, etc. It is not that impactful to healthcare growth, but the growth is coming from innovation. So innovation is actually important. Innovation, that means the healthcare companies can come out new products to meet the healthcare demand that was not met before, and that is actually the future drivers for the healthcare companies. There one area actually we particularly like as of now. It is about the innovation in oncology. So the cancer is now still the largest killer in the world. Now we're actually gradually out of COVID. We understand a lot of focus of the products were about the COVID, including the testing kits, vaccine, drugs in past like 2 to 3 years. But now actually after we normalize the livelihood, they actually they will be back to the previous focus, like the oncology. Oncology is still one big killer in the world for human beings. Then actually there are different types of oncology in the world, oncology treatment in the world. And we do have some view about select areas will look more promising than the others. And one area we particularly like in the moment is antibody conjugated technology. So this is a technology that actually will put a link into this antibody. Actually, this kind of treatment can recognize the cancer cells directly. As of now, the human immune system cannot recognize cancer cells versus the healthy cells, but this antibody linkage actually can tell that. And then there will be a drug, the cell-killing drug, put directly into the cancer cells and kill it. So this will be not harmful to the healthy cells. Well, that actually will be the next generation chemotherapy in our view. But actually, we had some products in the market using this ADC technology to treat the cancers already, and the result was actually, we can say as the latest development is the best in class in terms of the cancer treatment. We have one product actually is now very popular for like breast cancer, and the same technology actually can be used for some other cancers like lung cancer in the future as well. The clinical trials data is pretty strong. So overall, like ADC is something we believe will actually see a larger monetization in coming years that we like.
Very good point there. I mean, just to go a bit deeper into that, because I read a lot within this space as well, especially for oncology. So, in Asia, you've got all these experimental tech that, have also had very successful trials, right? So, do you have a perspective on that? The Asian markets, I know we covered a lot of the US, but what is the relationship between, Asia and, the global stage going into the new year?
Yeah, actually, we do see a pretty fast and a strong growth from the Asia healthcare segment in the past like 3 to 5 years. I think about 5 to 10 years ago, the pharma and biotech was dominated by the US and the Western companies. But now actually we are seeing more and more Asian or emerging market companies to come out thanks to very strong R&D in the past couple of years. But in the meantime, we have to mention that the strongest products are still largely coming from the Western at this stage, because actually those companies have better R&D resources to have a group of the pipeline products. While in Asia, we always see actually quite many companies, they only have like one or two or three pipeline products. So it is more like a single product focused company versus a lot of like Western companies. They have 10, 20 potential strong products. So from the likelihood to succeed perspective, the Western companies will still be better in terms of if that's a long-term investment. The other thing is actually the R&D actually is actually consuming a lot of cash flow. So R&D is actually, we cannot say it's burning money, but it actually need a lot of money to support in the longer term. In past like a couple of years, the capital market is very strong in Asia as well. They actually supported a lot of R&D for those emerging healthcare companies. But this year, year to date, we can see for those companies, relatively more difficult to get equity financing in the market. Then because of the derating and actually a lot of cases, the private companies is trading could be potentially high, even higher multiple than the public companies, which was not is not that reasonable. So from that perspective, in that case, the smaller companies may have bigger difficulty to continue their R&D if their cash flow is under pressure, especially for those companies without existing products. Then all their R&D expenditure should be from the shareholders' money, or they need to raise the debt, which is getting difficult now. So that actually we expect more M&As, the merger and acquisition will come out. Some smaller companies may sell to the big companies to continue their study, etc. And the big companies' perspective, you can see all the large pharma, biotech, they're actually pretty rich in terms of the cash, and they're happy to acquire promising projects to drive potential future growth. So we believe there should be more cooperations between Asia and the West drug companies to come out for the R&D cooperation to drive a better performance. Just like what I mentioned about the antibody conjugate technology, the breast cancer products, it is actually cooperated by a European company and one Japanese company to come out. So we will see more such development, co-development in our view.
So Ben, because I also read about, within the experimental space, there were some, successful trials, like, for example, they would put, a particular chip into the liver, for example, or the colon, and it would actually kill the cancer from the inside. And, there were some successful cases with that, and that came from Singapore. So, just to wrap up, if we were to localize it to the Singapore market, what would you say is that major strength and the potential risk in investing within the space?
Okay, sure. We believe actually Singapore is now becoming a hub for a lot of healthcare innovation. We do see actually quite many regional or the global companies are sitting in their hub in Singapore or announced that they're going to do that in past like 1 year or 2 years. That is actually definitely will be making the region and the city more promising and engaging in terms of the potential future development. Because as I mentioned, all the R&D need the money, so they need the investment. So the more investment there should be some better outcome there. But in the meantime, we need to be patient because the healthcare innovation is not something that easy. You can see actually a lot of drug will take 5 to 10 years or 10 to 20 years for development before they come into the market. So it is not something we invest like $1 billion now and we will get the results next year. It is not the case. So healthcare should be, investment should be patient. It is actually consuming quite many years. So for Singapore, we do see a very strong growth and investment in past years, but we need to be patient. And we believe the outcome will be good, but it may take a longer years than current investors expected. But the travel of the direction of travel is there because the better there is investment, better talents to come to the city, the outcome will be there, but just we need to be being patient.
Thank you so much, Ben, for the chat and also for sharing the insights just now. We'll be back with you shortly because I would like to show them how they can apply what they learned today. And then we'll go into a live Q&A to end off the session. See you soon, Ben.
See you.
Okay, the first giveaway to everyone, if you've been joining us for the past shows, it's our way to reward you for being here with us. Thank you once again, always for your support and being on this learning journey to grow and educate yourselves, because that's so important, with every single personal strategy or even decision that you're about to make. So this is how it works. Yes, hi, welcome to the new people as well. For the first 5 people who get it right and also answer it as quick as possible, you walk away with something from us, all right? So for the first question in 3, 2, 1. Which of the following are reasons to invest in healthcare? Is it A, underpinned by robust demand of growth drivers, B, offers resilience, and also with a history of greater downside migration relative to equity markets, C, powerful diversification characteristics given its limited reliance on economic growth, or D, all of the above? What do you think? Congratulations to all our winners. Great stuff. The answer was D, all of the above. Congrats. All right. So we want to know now how you can actually apply what you learned today very quickly. I'll just show you how you can do so because I'm already getting a lot of questions related to this. Okay. So if you go to your MooMoo app, it should open and show you this page. Are you following me? If you're following me, type yes. Great stuff. Okay, go to Money Plus, trade button right there. Go to Money Plus, and you'll see that you open it up to the Fund Houses page, right? Fund Houses page is very, very simple and straightforward. You just click on that. You can see all the available funds that you can, look at and explore for yourself. But for the purpose of today, let's use BlackRock. All right. Click on BlackRock. Leads you to the page like this. Now, this is very comprehensive, and I track this daily because I always need to look at, what was the latest trend in this, what is, the yield, what are the data points and the NAV values for this particular fund. So, you've got a whole list from BlackRock right there. It's a lot, but let's just, for example, click on the BGF World Health Science Fund. Click on that. It should open up to this page, okay? So this is just an example as a reference point. Don't take this as the final. But if you were to go onto this page, the instruments within that page are very important. These are tools that can guide you and help you make a decision regarding that. So you've got the NAV, net asset value, right here. And then you can see the percentages and also the comments, news, and analysis related to the fund. Okay, so the trend charts is an important one, but of course, I'm a customizable person, so I love to customize according to what I need to see for my own investment appetites. So you can customize accordingly, and you can adjust your time horizon and to track the daily live feed changes related to this fund. Click on analysis, and you should be able to get all the information, the documents, the history components related to it, and also it gets updated daily. So if we have any real-time updates, you might want to check it out just to educate yourselves regarding this fund. So if you're ready, just click on subscribe. And a lot of questions on this. You just have to input a minimum of 100 Sing. But if you want to change particular components, you'll have to look at all the other funds. And of course, it's really dependent on the currency as well and where it's situated. So for this one, of course, Singapore dollars, you are interested, you can click on it and you just have to link your universal account before you subscribe to it. So that was a very, very quick way you can apply what you learned today, but there's so much more information out there and there's just so much more you can do. So be sure to stay tuned for more educational content from us. But also, our teams are here to help you and guide you with your investment decisions, all right? So anything else you have, we've got an email towards the end that you can drop us your questions for, but also use the chat box right now, whether you're on YouTube or whether you're on MooMoo TV in the app. You can just type it in and our teams will take note so that we can reach out to you if we get back to you as soon as we can, okay? Hope that was helpful for everyone. All right, quiz number 2 as the giveaway. Before we go into the live Q&A for everyone. Are you ready? In 3, 2, 1. The technology sector offers attractive dividend yields. True or false? This is pretty straightforward, so I hope you get it right. Fastest fingers first. True or false? All right, looks like we have our winners. Congratulations to you. Our team will be in touch, all right? And thank you once again for joining us today. And I see new people joining in. Welcome, welcome. You're on our show 5 with BlackRock, Healthcare and Technology Outlook. May I now invite Ben back onto the floor so that we can go through our live Q&A and have a discussion related to this topic. Hi, Ben. Welcome back.
Hi, Olivia. Yes, I'm back.
Welcome back. We've got many, many questions, but of course, I'll pick out the top ones that I believe are most relevant to today's topic and will benefit our audience watching. So the first question, what is the latest innovation theme in both tech and the healthcare sector?
Yeah, sure. In the tech, we believe that maybe the nascent or the latest innovative theme should be something relating to like a metaverse or about the Web 3.0 because it's more decentralized technology in the future. It is actually we could potentially see a broader applications of that. Because now actually we are now talking about centralized internet that actually require the internet linkage for every piece of the content in the web. That actually in the future could be some decentralized content there that actually could be a potential theme in coming like 5 to 10 years. And some other nascent theme could be, in our view, will be a tech competition between the East and the West, because actually now China and the US are increasing their own investment into the hard technology or core technology segment. In our view, majority of the major economies in the world will like to secure their, for example, the semiconductor supply chain in their onshore. That actually they have to invest more into the supply chain in the domestic market. So that actually will be another theme we can watch for, because that means investment means the opportunities will be there. And also some self-sufficiency theme as well. That actually they want to more like domestic-made supply chain to substitute the imported ones. Then actually could be some investment opportunities there. So these are the new themes we like in the tech. For healthcare, actually, as I mentioned, like the oncology treatment is one thing we particularly like in the moment. But there could be more than that. For example, the wearable device, in our view, will be an interesting theme to watch for as well, because given technology improvement, then a lot of wearable devices actually can help monitor and check the situation for the patients constantly. That is actually more convenient and improve the livelihood for the patients as well. That is actually one area, the wearable devices. And the third one could be potentially on the devices side, like the robotic surgery. We still believe in the future there will be more robots doing the surgeries than the human doctors. We're seeing more and more applications or robot-assisted surgeries happening in the world now, especially in the US, but we also see some applications outside US as well. Then actually, given the technology will continue to enhance in our view, then more and more robots will take the role for human doctors. That is actually a long-term thing we like as well.
I like the point about robots, because I was reading as well, and I actually had previous interviews before with people or scientists working on synthetic pain, for example. So trying to use robots to, enhance precision but also complement the humans within the process. So thank you for highlighting that. Now, Ben, next question. Someone would like to know, will we experience another tech bubble next year and beyond?
Well, I have to say the definition of bubble may be different from people to people. But actually, everyone has different definitions for bubble. But our view is, if you are talking about a bubble, that should be something without fundamentals. It is a totally synthetic scheme that is actually nothing can be materialized. And then the valuation, the pricing was unreasonably high, and then go bust, and then nothing was left. So that actually there could be some, we call some bubble. But for technology, we do not see that it's happening in a moment, given that we did have a very high valuation, like starting from actually the beginning of the last year, and now we derated, as I mentioned, we're about halved in terms of valuation. But this is our view. It is still a macro-driven re-rating and derating. It is an interest rate cut due to the COVID, and now actually interest rate hikes due to the inflation. The valuation for growth segment will naturally go up and down. So that is actually the cycles of the market. However, the fundamentals is relatively remain very strong. It is some deterioration, as weakening or slowing down, but the fundamental at the absolute level, it is still very strong. So we can't say that a big tech companies that they actually should be treated as a bubble, because actually they are doing very well in terms of the key fundamentals. They're delivering like smartphones. They're doing delivering the softwares. They're doing their cloud business. The revenue is continue to grow. It is real revenue there we can see. So it is not the stock price can be traded higher or lower, but it is not a bubble because they're doing the real business. What is not a what is could be regarded a bubble should be something no materialized revenue. It is just talking about the long-term theme without any revenue potential. Then that will be bubble. But we're not seeing that in the tech in the moment.
Mm-hmm. Got it. So with inflation rising, what is that expected trajectory of healthcare costs? So, we covered several time horizons just now, but, what do you expect in terms of the cost part of healthcare?
Oh, it will depend on which part of healthcare you're talking about, because for farmers and the biotech, then the cost inflation is relatively muted. Given they do not consume too much like the labors or the energy, etc. Some part of the healthcare will see some bigger impact from cost. One is, for example, the clinical services or services providers like clinics, private hospitals, home care services providers. Then actually the wage inflation will have the cost inflation, will trigger the cost inflation because actually a lot of like nursery services. On the other hand, some devices companies may see some cost inflation as well because of the rising commodity price. So many devices, they need some metals or some precious metals for the equipment, or they need the consumer electronic components like the chips for some of the electronic devices as well. They actually will see some cost inflations. Overall, we do not think that inflation will be a big burden or big issue for healthcare as overall, but in certain part of that, we'll see some impact, especially from wage inflation to the services providers.
Mm-hmm. So given the stance on the zero COVID policy in China, a hot topic right now in discussions, do we see more opportunities within perhaps the pharmaceutical or medical devices companies over there? We could even compare if you like.
Yeah, we actually believe that given the recent official tone, it is a gradual relaxation of the COVID control will be the direction of the travel there, but just that it will be a gradual one rather than a swift one.
Overnight.
Overnight, it looks like to see. Maybe the government there will like to do some more preparations for potential reopening, that including the vaccination rate, including the capacity of the hospitals, and including the COVID-related drugs, etc. So there are a lot of preparation we can talk about that actually will trigger some demand. So we are talking about like some vaccines. We do have many domestic-made vaccines available in China. Then actually, if they want to boost up the vaccination rate, especially for the young people or the elderly or the kids, then actually there will be some potential benefit to the vaccine companies, and also the domestic, like they are developing their drug COVID drugs, etc. They have some Chinese medicine there as well. So all this actually, due to the potential reopening, direction of travels, they could see some potential good positive impact, even if including devices. Then if they want to reserve more like the ventilators in the hospital for potential increase of the patients there, then actually those demand will be increasing as well. So yeah, the travel of direction of travel is there. It will not happening swiftly, but it will be a gradual reopening and should trigger or boost some of the healthcare demand locally, including pharma, including devices.
Interesting point you brought up there about the traditional medicine space. So, I personally feel that in Asia, there is that difference as well, or complementary elements within that space of medicine. So do you have any insights to share within that and what to look out for in Asia for opportunities within that space?
Yeah, frankly, we don't have too much insight to share on that space because actually we do not invest much into the traditional medicines area. But we do understand that there are some big demand within the region about this type of products. So there could be some opportunities within that, but frankly, we don't invest in too much. So sorry, not too much insight we can share on that front.
Yeah, I mean, someone already asked that question regarding that. Okay, but thank you for sharing your insights related to China. So I guess the last question that someone would like to know is, right now I am unsure about, my stance and my portfolio in terms of asset allocation within this space. So I guess to end off, what would you say your insights are for asset allocation for healthcare and technology?
Well, these two are both like sector investments. So actually, to some extent, some investors will believe they are more like a thematic investment approach, etc., because it is only investing in one sector. So that really depends on how investors risk appetite to this kind of single sector investment overall. In the longer term, actually, the healthcare and the tech actually both outperformed the equity market in past like 10 years or 20 years. That is, in a longer term perspective, these two outperforming sectors. Healthcare will be more resilient, less volatility. If for investors with less risk appetite, they wanted something more stable within equities, then healthcare actually be a good candidate for them because this sector actually outperform in the longer term in history, and also actually is still relatively cheap in terms of the valuation, relatively steady growth from a fundamental perspective, and people can feel relatively more resilient if they're holding the healthcare. For tech, I think it really depends on the market environment and the sentiment for next year. It is about the macro inflation and the Fed rate hikes, pivot potential, etc. So it is more macro related compared to health. However, the good thing about tech investment at this stage is that the valuation has come down significantly. As I mentioned, it's halved compared to like 18 months ago. So from that perspective, if the investors have the higher risk appetite, are willing to tolerate the larger volatilities, then healthcare may potentially provide a better growth because healthcare is a growthy sector, and in longer term, we still believe in the long-term growth for fundamentals of the technology sector.
Mm-hmm. All right. Thank you for answering the questions. And to the audience, thank you for being a part of the discussion. Now, Ben, to end off, what is that last takeaway you'd like to give the audience before we end?
Yeah, sure. So for investors, if there are concerns about next year, or they are looking forward to next year is about the potential slowing down of the economy and the recession period, etc., then actually healthcare could be a potential candidate you can look into for your investment, because the sector performed very strongly in the history compared to other sectors in the recession period or the late cycle period. And for investors like to bet on the long-term potential growth, then technology is trading at attractive valuation as of now. So yeah, both are good sectors with a long-term potential, but for different sectors, different investors to depend on their holding period, long-term investors and potential, and also about the risk appetite, they can actually decide which one should be better for them. Thank you.
Ben Bay, everyone, a product strategist at BlackRock. Thank you for joining us for show 5 on healthcare and technology outlook for 2023. We'll see you next time, Ben, for the next shows.
Thank you, Olivia. Thanks, everyone.
Thank you. To the audience watching, I would like to present you with the last giveaway for today to reward you for being here with us. Now, for those of you who missed out for the previous half of the webinar, be sure to pay attention to this one, okay? So for the final giveaway, top 5 fastest fingers, and you've got to get it right. The question is, in 3, 2, 1. The following statements accurately describe technology companies today, except A, have favorable fundamentals, consistently reporting strong earnings above expectations, B, rapidly extending into every industry and reshaping the global economy on multiple fronts, C, are illiquid and have steep valuations, or D, supported by secular growth drivers such as global tech spending. Remember the keyword, except, all right? What do you think? Great stuff. Look like we have our winners. Congratulations to the top 5 who listened and understood what we meant by that. Now, congratulations, and we'll see you for the next upcoming giveaways that we're going to have for the next couple of shows within the week. Congrats. The team will be in touch. Okay, so that's about it for today's show. Thank you once again for being a part of this journey with us. If you want to know more about the shows for tomorrow onwards, you'll get to find out here by scanning this QR code, because this is where you can get all the in-depth information by our communities, by our teams. They work very, very hard, our research teams and also our community teams, to put together this content for you. And of course, from a broadcast perspective, we really want you to learn as much as possible. So follow this for more information. And for the socials, of course, we've got our main shows. We've got fun edutainment content for you every day. So really check out the community forums for this, and also follow the Instagram pages if you want quick click-ins to the links and also fast updates to what we have in store. And whenever we're live, we always make sure you know it. So I'm not going to tell you more about that. I want you to check it for yourself. So scan the QR code to find out more. And of course, World Cup is happening right now, right? So if you're interested in, the campaigns ongoing, it's not just about the campaigns. We're always in the know to what's relevant right now in the markets. And so we're always here to help you fight that battle against inflation. And we always try to offer as much as possible so that we can help people in their investment decisions. So check out more details if you're interested in this. All right, so that was the healthcare and technology outlook. Our next show will be on navigating the uncertainty, reasons for optimism. Now, we've covered a whole range of topics lately. We've covered different sectors as well. We've had different kinds of experts on the show. And so these are different tools, different episodes that can help you with a wholesome picture for an overall better investment strategy. So 1st of December, Thursday at 3 p.m. tomorrow, we're back for the next show with our next speaker. So if you want to find out more about this, remember to follow our social media pages so that you can have a fast click in to the shows when we're live. I hope you enjoyed that. And thank you so much for being with us today. I'll see you for the next show tomorrow to kick off December and as we go into the new year. Once again, I'm Olivia Higgins, and I'll see you tomorrow. Bye.